Question that we often ask in personal finance is, am I handling debt responsibly? And I think for the most part, many people have the idea that they're handling debt responsibly, but the reality may be a little bit different. And I think in large part, debt is a tool that can be used to acquire a lot of great things like homes and cars and other assets of some kind. But unchecked, that can become quite dangerous and can potentially lead to insolvency and bankruptcy. And that's ultimately not a road that we want to go down. And so what we're going to talk through in this video is how to determine quantitatively whether or not we have too much debt. And by too much debt, I mean to the point that it's going to start to bleed into other areas of our finances, and we're not going to have a great deal of money to spend on other things besides that debt. And so what we're going to be doing is calculating what we call the debt to income ratio. So if you've had any involvement with banks or worked for a bank before, you're going to be pretty familiar with this simply because it's a common tool used by lenders to evaluate someone's ability to pay. And so the debt to income ratio is an industry standard with regards to lending and helps provide a little bit of insight into whether someone might have an increased likelihood of defaulting or is a relatively safe bet, if you will. So to calculate the debt to income ratio, we need two things. One, we need to know our monthly debt payments. So this is how much we pay on our debts to kind of fulfill the requirements of whatever loan we have in a given month. And then we divide that by our monthly gross income. So as an example, let's kind of walk through and do a couple of calculations. So let's assume that we have a couple of different debts. Let's assume that we have a car payment, which is pretty common for most people. And let's assume that car payment is $500 per month. Let's say it's another $300 per month that we pay in credit card bills. And the last thing that we have is we've got a student loan. And so the student loan, we pay another $200 per month. So grand total altogether, we pay $1,000 in monthly debt. Notice that we don't have a mortgage, so we're just calculating non-mortgage debt. If we did have a mortgage, we would obviously include the monthly payment for that here, which would certainly have an impact on our debt to income ratio. So the next thing we need is our gross income, which I'm going to provide. So we're going to go ahead and take that $1,000 monthly mortgage debt, and we're going to divide it by our monthly gross income. And let's say our monthly gross income is $4,000. That's how much we get on a monthly basis. Keep in mind that this is gross income, which means this is essentially what you are paid. However, it doesn't factor in all of the taxes. So if you want to use a more conservative figure, I would recommend, instead of using gross, use your actual take-home pay. This is a very conservative way to calculate your debt to income ratio. But the way that I always look at it is the take-home pay reflects the money that you have in your disposal. So it kind of makes sense to use that ratio for the purpose of calculating your ability to pay versus money that is going to taxes and you're not going to be able to use at any point. Ultimately, it's up to you. Most in industry use monthly gross income, but for personal reasons, I like to use take-home pay just to be a little bit conservative. So let's assume we've got $4,000 in monthly gross income. What this means is we have a debt to income ratio of 0.25 or essentially 25%. So what this means is a couple of ways that we can interpret this. The first is that for every dollar that we make, we're taking 25 cents of it and we're paying it on debt, right? So a quarter of our income is already gone right off the top. Now that sounds pretty extreme, but most financial advisors recommend not to exceed a debt to income ratio of 36%. So this is considered to be kind of the ceiling, if you will. You want to have your debt to income ratio below that. So notice we're at 25%. So by all intents and purposes, this is considered to be relatively safe. So from a lending standpoint, a lot of creditors would look very favorably on this. Obviously, the lower that it gets tend to be the more favorable it is. And the lower it gets also, it tends to make improvements on your finances, because here, I mean, this is basically $1,000 that we're committing just to ongoing debt payments. If we were in a position to pay off those debts, that would provide a very positive impact to our budget and would give us the ability to do a lot of great things, whether that's saving for retirement or saving for an emergency fund or just saving for something fun like a vacation and that sort of thing. Regardless, it's important to calculate the debt to income ratio for your personal finances so you have an understanding of ultimately where you are financially and if you need to make any adjustments in terms of potentially paying off debt or maybe even looking for opportunities to increase your monthly gross income or take-home pay.